Hi everybody, I'm just going to do an example for the homework problem 1. I just wanted to talk about a couple things first, and I'm going to upload some of my older videos, and that'll give you a lot more information on the subjects for this week also. But first I just wanted to always remind you, assets equal liabilities plus equity. This equation must always be in balance. So when you are doing journal entries, remember that entry you're doing, in the end, the debits must equal the credits. So you could have 2 debits, 1 credit. You could have one. You could have 1 credit, 2 debits. However you're doing it, in the end, they have to equal each other out. Your debits must equal your credits. Debit, the word just means left, means nothing else. It has no value. Credit just means right. It means nothing else. And when we're talking about left and right, we're talking about sides of a T account. This is a T account. It's an easy way to keep track of different accounts. We use it basically in place of a ledger because it's easier to work with. And that's all debit and credit means. So don't think they mean good or bad or increase, decrease means nothing. It means left and right. They can impact the various accounts in different ways. And that's what this term, I always found it easiest to remember the word dead. There's all different words you can use. But what dead means is these types of accounts will increase with the debit. Your expense accounts, your asset accounts, your dividends, or if we were talking about a sole proprietor, it would be your owner's drawings, will all increase with a debit and decrease with a credit. All other types of accounts will increase with a credit and decrease with a debit. The only thing I'm not taking into account with the word dead is losses and gains. But we don't talk about that for a while. But since I mentioned it, losses increase with a debit, decrease with a credit. Gains increase with a credit, decrease with a debit. Just so you know, what the way a T account works is you put the different account names on it. This, remember, left means debit. So this is our debit. Right means credit. This is our credit. So for example, if I wanted to use the account cash, cash is an asset account. According to this term, remember, dead, assets increase with a debit. That means if I got $100 of cash, I debit cash for $100. If I had to pay something, say with $50 cash, I would have to credit it. So again, it just depends on the type of account you're talking about as to how they'll work with, if debits will increase them or credits will increase them. So I'm going to go over a bunch of journal entries with you. An example for the first homework problem. I'm going to upload all my old videos I had taken. And I would go through those, even though you don't need them perhaps for this week's homework, but they're going to help you in the end. The only other thing I want to remind you of is it's really important to remember what each account is. What type of account is it? So you know, is it an asset, a liability, or an equity account? So for example, assets, the ones we'll talk about this week are cash. We all know cash is. Accounts receivable. Accounts receivable is if I go into Macy's and I buy a blouse and I charge it on my charge account for $20. I am an account receivable to Macy's. Transaction happened, but they didn't physically collect my money. So I'm an account receivable to them. That's an asset. Inventory. We're going to talk about that down the road, but inventory is an asset account. Equipment. If I purchase equipment or furniture, those are asset accounts. Supplies. If I purchase a supply and I keep it, I'm not using it, that's an asset account. Liabilities are basically things I'm going to owe. So if I were to buy this pen at home or wherever at Office Max, and it cost $2 and I didn't pay for it, I charged it, that would be an account payable to me. I've got the pen, the transaction happened, but it's not paid for yet. So that's a liability. There's different liability accounts. We'll probably talk about them as we go along. I think this week we only talk about accounts payable. You have short-term and long-term assets and liabilities. Basically, it's an order of liquidity. So for your assets, the most liquid assets are going to appear first. If an asset is going to last you for more than 1 year, it's considered a long-term asset. Equity is our last thing, and if I'm talking about a corporation, my equity, for example, might be called common stock, capital. Those are all that's going to be an equity account. You're going to also have, when you're looking at these accounts, technically, your expense accounts fall into that equity account range, but they decrease your equity. So remember, equity is going to increase with credits, decrease with debits, right? Because any of our equity accounts. So if it's increasing with a credit, for example, common stock is going to increase with a credit. So if I have common stock, or I think they call it capital stock in our text, if some investor, say somebody buys stock and gives us $100, I would debit cash for that $100. I've increased cash. Now to increase my capital stock, I'm going to credit that because capital stock's going to increase with a credit. So again, everything, if you look at DED, expenses, assets, and dividends are all increasing with debits, decreasing with credits. Everything else, we're not talking about losses and gains, everything else will increase with the credit, decrease with the debit. Losses, which we talk about much later, increase with debits, decrease with credits. Gains, increase with the credit, decrease with the debit. So next I'm going to go through all our journal entries.